I wrote a book 6 years ago called The Little Book That Beats the Market, and it really gave a very simple way for people to beat the market. I actually ended up, after I finished the book, getting worried that people would kind of screw it up, and I was really trying to help people. And there aren't great data sources and everything else, so we actually set up a website to do everything for them. Except that I made a little mistake. It actually ended up being pretty hard. I tried doing it with my kids and managing a portfolio of 20 or 30 securities and keeping track of the taxes and everything else. It turns out most people don't, it's kind of hard to do it yourself, and I even found it hard with my own kids. So I learned a lot. We did a lot of research since the first book, and learned some more things, and came out with something that I guess is even easier for people to do, and also takes advantage of our latest research. Well, it's pretty interesting that from the research we did in the book. Most people know that the typical index funds, the S&P 500 and the Russell 1000, if you invest in those, they beat most managers, roughly about 70% of the managers. And that's pretty powerful. It's because of their low fees and that most managers aren't really adding value. So one logical thing to do would be to say, well, I know only 30% of the managers beat the typical index, so how do I find those guys? And it turns out if you look back over the last 3, 5, and 10 years of those managers' records, there's really no correlation between how they do in the next 3, 5, 10, which is really what you're trying to figure out. And that really is that they're market cap weighted indexes, which means they put more weight into the larger market caps. And so that if a stock...
the losers.
Right, so if you believe like Ben Graham or Warren Buffett, that the market's sometimes emotional. It's not efficient like so many professors have professed over many years. It's not efficient. That means that if the market does get emotional over the short term, that some stocks are overpriced and some are underpriced. And a market cap weighted index, if a stock is overpriced, it buys too much of it automatically. And if it's underpriced, it buys too little of it automatically because it's based on market cap, which is essentially price. So it sounds crazy, but it actually is systematically doing the wrong thing at every point whenever there's an inefficiently priced stock. And so there's an easy way to correct that. And there are actually equally weighted indexes. Instead of putting more in the larger market cap companies, it actually puts an equally weight. So if you have the S&P 500, it'll put as much weight in stock number 1 as it will in stock number 500. It still makes plenty of errors. In other words, it's an equally weighting, but those errors are now random, not systematic like a market cap weighted index, so you actually get back the 2% a year. And there are a few people who have come out with something called fundamentally weighted indexes. It's just another way to weight stocks without using price. Sometimes. I mean, my definition of value investing is figure out what it's worth, pay a lot less. It has nothing to do with low price book or low price sales. And so that's how a lot of people like Russell or Morningstar would classify value investors. And so they probably wouldn't classify me as a value investor or a growth investor. They kind of don't know what to do with us. And, as Buffett has said, growth and value are tied at the hip. I mean, part of what makes value is investing in a business that can grow over time. So they're not two different way they're classified by, let's say, Morningstar or Russell. Maybe there's much lower growth in value and much higher growth in growth, and they make it that way. But I'm looking for good businesses that are cheap. Ben Graham said, figure out what it's worth, pay a lot less, leave a large margin of safety. Between those two, big space between those two things. Warren Buffett, his best student, made one little twist that made him one of the richest people in the world. Buffett simply said, if I can buy a good business cheap, even better. Part of good is a business that can grow over time. And so I slowly gravitated, not fast enough, certainly in my first decade of investing, gravitated more towards the way that Warren Buffett invests. He's looking for good and cheap businesses, and growth is part of sometimes being good.